Welcome to Economic Deep Dive, where we break down the world's biggest financial events and the hidden truths behind every major shift in the global economy. In today's video, we explore one of the most important and fascinating topics in financial history: the three positions that survived every crisis since 1929. From the Great Depression to hyperinflation cycles to the 2008 collapse and even the COVID-19 market shock, these three positions have consistently shown resilience while the rest of the world was falling apart. Get ready for a clear, powerful, and engaging deep dive that reveals how global markets, money systems, and real-world events truly connect. Stay till the end to understand the full story. When we look at the last century, we see crisis after crisis, each with its own unique triggers, but all with the same destructive pattern: fear, collapse, panic, selling, loss of confidence, and the failure of assets people once believed were safe. In 1929, the world saw one of the deepest market crashes in history. Stocks collapsed more than 80%, banks failed by the thousands, and unemployment reached levels unimaginable today. The world economy felt frozen. But even in that chaos, certain positions didn't break. They didn't just survive, they became lifelines for millions. Then came inflation cycles. Throughout the 1970s, inflation surged to double digits. People watched their savings lose value faster than they could earn. Cash was no longer king. The dollar weakened. Central banks struggled to stabilize the economy. Yet again, the same three positions held strong. Not because they were lucky, but because they were fundamentally built for chaos. Fast forward to 2008, one of the largest financial collapses in human history. Wall Street giants crumbled. Mortgage-backed securities wiped out trillions in wealth. Corporate giants and ordinary people both suffered massive losses. But the pattern remained. These three positions still survived. And when COVID hit in 2020, global markets collapsed almost overnight. Cities shut down, businesses closed, oil prices briefly went negative. The world entered uncertainty. But the historical trend repeated. The same three positions kept their strength. So why do these three positions survive while everything else collapses? The answer lies in a powerful economic truth. Real crises don't destroy all assets. They reveal the difference between speculation and survival. They expose which assets depend on market sentiment and which are rooted in real, long-lasting value. Let's start from the Great Depression. When people lost trust in banks and the stock market crashed, what did they turn to? They didn't turn to speculation. They turned to things that represented stability, necessity, and long-term reliability. They turned toward assets that could exist even if the financial world collapsed. And that is where the first crisis-proof position begins. As we move into the inflation era of the 1970s, we see something interesting. Inflation destroys savings, punishes cash, and eats away at the value of salaries and deposits. But not all assets fall during inflation. Some rise sharply because they benefit when currency weakens. These are assets that don't depend on a stable dollar to hold value. They are rooted in physical scarcity, fundamental necessity, and global demand. Then, in 2008, the financial world fell apart not because of war, or natural disaster, or pandemic, but because of pure financial engineering. Derivatives, subprime mortgages, leveraged bets. The entire system buckled under its own weight. Yet even in this environment, people moved their money toward these three positions because they were afraid of losing everything. And historically, fear always guides capital toward the same safe zones. Now, when COVID struck, markets reacted emotionally at first. Panic selling, liquidations, margin calls. But within months, something predictable happened. Capital started flowing back into crisis-resistant positions. Why? Because people realize that even if the whole world shuts down, certain forms of value do not disappear, they remain essential. These three positions have survived global collapses for almost a century. They have outperformed stocks during crashes. They have held value during inflation. And they have historically acted as safe havens during panic and uncertainty. They are not magic. They're not get-rich schemes. They're simply the most structurally resilient positions in economic history. The first position is built on scarcity. something the world cannot print, cannot manufacture instantly, and cannot inflate away. This position holds value because it is limited, desired, and globally recognized. When trust in governments and central banks goes down, this asset goes up. When currencies weaken, this asset strengthens. It has worked for thousands of years and continues to work today. The second position is built on necessity, something essential regardless of what the economy looks like. Whether it's recession, depression, war, or pandemic, people need this sector every single day. It doesn't depend on market hype or speculation. Its demand is rooted in real life. Companies in this category have survived every major downturn because they serve needs that don't disappear. Even when luxury markets collapse, this category stays strong. The third position is built on ownership, not speculation. It is something that produces value regardless of whether markets are rising or falling. This position generates income, protects against inflation, and historically recovers faster than stocks after economic shocks. The world might change, currencies may shift, crises may come and go, but this form of property remains one of the strongest economic foundations in human history. Each of these positions survived 1929. They survived the 1970s inflation crisis. They survived the 2000 dot-com burst. They survived the 2008 collapse. And they survived the COVID market crash. The reason is simple. They are rooted in real value, real scarcity, real necessity, real ownership. But here's the deeper truth. These positions didn't survive because they were lucky. They survived because every crisis exposes the weakness of speculative assets and strengthens the value of foundational ones. When markets go up, people chase hype. When markets crash, they run back to fundamentals. And fundamentals always return to the same three pillars: scarcity, necessity, and ownership. Think about this. If you could only hold three positions during the next major economic collapse, what would they be? Would you hold assets that depend on market sentiment? Or ones that have survived every major downturn for almost 100 years? In modern times, people often forget history. They think crashes are rare. But in reality, crises come every decade. Some crises are financial, some are structural, some are global. But every single one leaves a lesson behind. Only assets built on real value survive. As we continue this deep dive, look at the historical pattern not as financial advice, but as a powerful reminder of how the world really works. Markets rise, markets fall, governments change, currencies weaken, but these positions remain standing. Our global economy is more fragile today than ever before. Debt levels are at record highs. Inflation is rising in many countries. Currency values are shifting. Banks are taking on more risk. Technology is changing industries at lightning speed. Geopolitical tensions are increasing. And economic cycles are tightening. All of this makes one thing extremely important: understanding which positions will survive the next major crisis. History doesn't predict the future perfectly, but it shows us something incredibly valuable: patterns. And the pattern is clear. Certain positions protect wealth across generations, while others disappear overnight. In the end, surviving a crisis is not about luck. It is about preparation. It is about understanding what has worked for decades, not just what is trending right now. It is about recognizing which assets hold value when everything else loses it. And as we have seen across the Great Depression, inflation cycles, the 2008 collapse, and COVID-19, the same three positions have consistently proven their strength. This video will show you why. It will break down the logic, the history, and the deep economic principles behind each position. And by the end, you will understand not just what survived the past, but what can survive the future. Stay with us as we uncover the full story, and welcome once again to Economic Deep Dive, where we reveal how the world's financial systems truly work, one crisis at a time.